Another point that I believe that's really relevant, I'd like to show you in the second graphic, is that, well, the mills in northern China have been showing particular interest in pellets, and this is due to the relatively lower impact, environmental impact, and the high efficiency in the blast furnace. So you see the growth of the participation of pellets in the blast furnace burden ratios, and probably this is a trend that will continue from now on. It's not only a snapshot. And this trend, coupled with the recovering demand from the natural markets for seaborne pellets like Europe and Japan, creates a shortage and a new pressure over the premiums for the next weeks and months.
So I think short term we're going to see some upward pressures in terms of iron ore prices continuing. I wouldn't be surprised to see them continue throughout next year, and I think we're flirting around where pricing is apt to find some footing. And if we go back to about 2008 to 10, iron ore prices were trading about 180 US dollars per ton. I certainly wouldn't rule that out as a possibility in the current market very short term.
Ultimately, on the iron ore side, we believe that the fundamentals are still very healthy. We saw a lot of activity kicked off with cyclone activity in Australia and the impacts of COVID on Brazil, obviously. But what we feel is happening in the last couple of weeks from the conversations with our customers is people are starting to really understand that it's possible that there's real tightness coming in next year. We saw disappointing numbers from producers coming out, the expected ramp-ups from Vale not materializing, missed by 10 million tons this year, 30 million tons down by consensus next year. We think it can go higher from here. The nearby dates have been the driver. People scrambling for iron ore units on the seaborne market right now as the steel mills fly in China and they have strong governmental support and new blast furnaces coming online, but also rest of world demand is what we're feeling in the short term. And as the rest of the world comes looking for these units too, it's bringing up the nearby dates. And that's been dragging the back end of the curve as well. The move has been a lot recently in the front, so we wouldn't want to be long right now, but we still think there's value in the back of the curve.
Another thing I want to highlight is that looking at this year, China's port inventories went all the way down to a near-term low, about 106 million tons sometime in June. So even back in June, we didn't see the iron ore prices going all the way up towards 150. So surely the port inventories and everything is not only the story behind the strong performance in iron ore. That is what I want to highlight. Of course, China all along since the start of this year, other than the first quarter, when the China is suffering from all this COVID-19, you will be able to see that, the steel output didn't really jump up too much, but afterwards it's been steadily growing. Nowadays, until October, we're looking at year-on-year comparison, 5.5% on growth.
China's growth was actually at the expense of the Western producers. I mean, a lot of the production moved to China, and as a result, it stifled the growth or even stifled the companies in the West. So therefore, it was a zero-sum. China gained, and the rest of the world basically stayed the same. Now, will the Western governments, who don't particularly appreciate China right now, continue to let this happen, or will they break down and say, look, we're going to erect barriers and we're going to keep these barriers up? Now, we know one thing by looking at China's trade deficit and trade surplus, that they did very, very well, especially exporting to the West, the United States and the EU and other countries. Now, that's a dangerous proposition because China is not exactly the most popular country in the world right now. But anyway, it's going to be a very interesting situation, but I do not see any spectacular sustained growth. I believe there's going to be an incremental growth rather than sustained an incremental growth rather than exponential growth in the near future.
Now, it's not only Vale that is actually underperforming this year, and it's what I am showing in my chart on the left-hand side. So there are other major producers such as FMG, Anglo, and CSN also is slated to produce less in 2020. So our expectation is that the global iron ore production will end actually 2020 just marginally above the level seen in 2019, which was about 1.85 billion tons. Now, on the right-hand side, booming demand from China and a weak response from the supply side really forced us to sequentially revise up our price forecast as the year progressed, and we now expect 2020 prices will average about $105 per ton.
Now on the prime scrap, it's a whole different world, because this prime scrap is coming from industrial and commercial manufacturers. And the other major issue in the prime scrap side is the export or the imports that are coming into NAFTA from Europe. It's normally 5 to 7 cargoes a month. Well, that's been restricted, and they're having major issues with getting that into the country. Consequently, the major electric flat carbon companies are going after remote scrap for their prime scrap because it's key to their low carbon and their low copper, high-end margin scrap or steel products.
Actually, when I was looking at 2020, we're actually at the last month already. When I was defined this year, I call it policy year, which means that the government actually put a lot of efforts. We can call it rescue or stimulate the economy. So the support definitely is from the government. But then if you look at the demand side, you have to split it regarding the domestic market versus the export market. If you look at the manufacturer products, electrical and electronic products, it accounted for about 60% of export. So I believe the demand, a part of the thing from the global market that is real. Whereas looking at the domestic market, because China, the development stage is not really a developed country, it's a kind of towards that end. So a lot of infrastructure construction project will be necessary, but it's just a matter of time whether you wanted to build it this year or next year or the year after.
Well, all the suppliers, they are also dealing with the exhaust depletion of existing mines. So we look to each mine, we're gonna see, as Cicero mentioned before, that everyone has to invest in order to cope with the existing depletion. FMG, you have Iron Bridge, you have Rio with Gudadare, you have BHP with South Flank. So everyone catching up to keep demand, and maybe FMG be able to increase a little bit. Okay.
When we think about the global seaborne market, we need to understand that actually the strength of the big four producers, right, which are essentially Vale, Rio, BHP, and FMG. So those four guys together, they hold about 80% of the seaborne market, right? So they have an immense pricing power. So the way we see Vale, actually, even though they say they can go up to 450, we have capped them at 400 million tons for now. Rio will be, over the long term, we understand, the second largest producer, reaching up between 350 and 360. BHP will come in third place with about between 280 and 290, and then it will come FMG with Iron Bridge now with between 185 and 190 million tons. So all these four guys, they will account for even more of the seaborne market over the long term, more than the between 78 and 80% that they account today.